$179 billion dollars. That's how much Canadian homeowners have borrowed against their homes using their home equity line of credit. And we just hit the highest level since March 2020. But that's not actually what the big note is here. While this is the fastest growth rate we've actually seen in 13 years, it's happening while home values, for the most part, are pretty stagnant and in some places cooling off. Now, if you own a home right now in Canada and are thinking about accessing your home equity, or you're wondering what should you do about it, I'm going to try to explain to you in the next 20 minutes how to do so and how to consider utilizing your home equity. Moreover, what's happening in the marketplace right now and why are Canadians accessing their equity like an ATM? Now, we'll talk about what regulators are warning us about and, more importantly, some of the key strategies to use your line of credit with. So let's break it right down right now. First, let's talk about what's actually happening right now, because the numbers tell a story I think that nobody's actually really spending the time to discuss. Now, picture this: in September 2025 and across Canada, homeowners collectively borrowed $1.2 billion in a single month. That's $1.2 billion in 1 month from their lines of credit. That's the biggest September increase since 2009. If you remember, that's when we had the last financial crisis. So we're talking 16 years, the biggest month. Now, the data itself says that, according to the Bank of Canada, the data says a HELOC balance has climbed to $178.92 billion September 25. That's 4.15% annual growth rate, the fastest pace since December 2012, almost 13 years ago. And this isn't just a 1 month fluke. This is 8 consecutive months of acceleration. I've seen it myself with my existing clients and people reaching out to me. I'm going to put this into perspective. HELOC, home equity line of credit growth, is now just under 1 point under mortgage growth. Think about that. Canadians are using their HELOCs more often, or almost as often, as they are with their existing mortgages. Now, historically speaking, Canadians have been pretty conscious with HELOCs, but right now we're tapping into them at a freaking record pace. Now, this is where things get a little bit more fascinating and kind of more concerning. Typically, HELOC growth happens when two things are occurring. Home values are rising rapidly, like we saw in 2021, and people are buying more real estate. Right now, neither of those things are happening on a regular basis. Home values across the country, for the most part, are pretty flat. There's some areas that are down and some areas that are cooling, with a couple that are actually up. But the big question is, why are Canadians borrowing against their homes at the highest rate in over a decade? That's the $179 billion question. But before we dive into it, we should probably explain exactly what a HELOC is, because there's a lot of confusion out there. And to be honest with you, I've heard it called anything from a HELOC to a HELOC to something else. Let's just quickly give you an explanation. Now, if you're thinking, I already know what a HELOC is, it's just borrowing against my house, you're half right, but the details matter, and I think most Canadians are getting this wrong. So home value is $800,000. Maximum borrowing limit total is a total of 80%, which is $640,000. Your current mortgage is $300,000, which means you have up to $340,000 in a home equity line of credit, as long as it doesn't exceed that 65% loan to value. Now, the good is, when used properly, a home equity line of credit is an incredible tool. You can use it as an emergency fund, obviously massive home repairs, unexpected medical expenses, job loss. The cost itself is going to be typically dramatically less than a credit card. Usually it's like prime plus 0.5%, prime plus 0.25%, prime plus 1%. The other thing you can use it for is investing. So obviously a lot of people utilize their home equity line of credit to buy a second property, and I think that's one of the places where people are taking their money right now. The third is that there's a flexibility factor here. You could pay only interest on the money that you have. And strategically speaking, you could take it out as you want to for investments. But there's a bad side to this as well. And the bad side is where Canadians are getting in trouble in a lot of situations right now. Number one is like lifestyle inflation. Home values went up 40% during the pandemic from 2019 to 2022. And during that time, people were utilizing their home equity line of credit like it was essentially an ATM. Basically pulling money out for vacations, for pulling out for unnecessary things that, well, maybe they thought it was necessary at the time, but probably didn't add any value to their investment or their lifestyle. They're also variable rates. So unlike a fixed mortgage, a home equity line of credit goes up or down. When the Bank of Canada raised rates from 0.5% up to 5%, there was a massive cost associated with the interest that people on a line of credit ended up paying. And as I mentioned before, there's the trap of the ATM. Because it's revolving, it's really easy to keep tapping into a line of credit over and over again. Now, according to the Financial Consumer Agency of Canada, which is OSFI, the Office of Superintendent of Financial Institutions, HELOCs can significantly increase the risk of mortgage default. And they're not making this up. During the US financial crisis from 2006 to 2008, have data suggest that 40% of mortgage defaults were involved with lines of credit. And the homeowners had borrowed against their equity when home values dropped and jobs were lost, and they were essentially underwater during that time. So with all that context, let's get to the big question. Why are Canadians tapping their home equity lines of credit right now? Here's where things get interesting. I mean, the traditional ideology for HELOC growth doesn't really apply right now. The first one is the pre-construction crunch that's happening. Think about what happened in 2020 to 2022. As we know, rates were at 1.5 to 2.5%, the historic lows. Developers were launching projects left, right, and center. And we've had plenty of conversation topics about what's happening with the shoebox condos in Toronto and Vancouver. But there's other cities as well, like Kelowna and other areas across the country where there's hundreds of pre-construction properties coming out. People were refinancing and taking out their lines of credit, 20% to put down on a pre-construction condo. Well, all those condos are coming complete now. And the problem is when those people were trying to get pre-approved to buy a couple of years ago, rates were 2 to 3% lower than they are today in some situations. And now that they're trying to close when rates are around 4.5% in most circumstances, a lot of them can't qualify for the entire loan amount. Or they don't have the capital because they didn't save up the money because they had a variable rate mortgage, which stopped their ability to save. Now, I think what's happening in a lot of situations is people are using their home equity lines of credit. I know this to be the case because I'm seeing it every single day. And it's actually increasing their down payments. It's making up the difference between appraisal values that are coming down, and it's covering some of the costs or expenses where cash flow is lower. In some cases, basically, it's bridging the entire financial gap for people to be able to buy these properties because the alternative is they let go of their whole deposit, and a lot of people don't want to do that. This would explain one of the big reasons that we've seen a surge in home equity line of credit. The cost of living crisis. I mean, let's be honest right now about what's happening in Canada. Inflation peaked at 8.1% in 2022. Grocery prices are up 20 to 40%. Heck, I think they said that coffee prices are up 45%. That's just coffee, let alone eggs that are up like 35 to 40%. We all know the story on all those types of things. Rent is also insane, and mortgage renewals are hitting homeowners left, right, and center right now for those who are actually qualifying for a loan in 2020 and 2021. Canadians are feeling stretched. I mean, there's no bones about it right now. And credit card debt is also at a record high. I think that people are using their home equity lines of credit, consolidate high interest debt and credit card debt, and cover their basic living expenses, which is kind of sad, but it's bridging cash flow gaps for a lot of families. And this is the most concerning theory because it suggests that there's financial stress, not financial planning. And the third is the investment property play. There's a theory that it's a bit more optimistic, but still somewhat risky, I suppose. Some Canadians that are real estate investors are using their lines of credit, as I mentioned before, to cover those cash flow and negative rental properties where rents haven't kept up to the mortgage payment increases, specifically the last couple of years. They're funding the additional down payment on additional properties right now and then covering maintenance fees and repairs that were not accounted for. If that's what we're seeing happening right now, it obviously represents a massive concentration of risk. The borrowers that are betting that their rental income will either catch up or property values will rise or rates will drop soon. And if they're wrong, we could see a whole wave of those forced sales that we talked about before. Now, we don't know the exact breakdown on who's doing what. I mean, I could speak anecdotally to what I see, but I'm not talking to homeowners who are in the distressful situations. I think it's a combination of all three of those things. And what we do know is that HELOC growth is accelerating in an environment where it traditionally wouldn't. And that suggests that Canadians are either facing financial pressure or quietly levering their real estate against more exposure. Now, here's the things get really, really wild, because whether you think this is a growing concern or not, the reality is HELOCs can be an incredibly powerful tool when used correctly. And I think there are other ways to use this. So if you're not one of those people and you're asking yourself the question, like, how do I utilize my equity more safely? Or if I have one, what does that look like? If you're sitting on $200,000, $300,000 worth of equity, even $500,000, you might be asking yourself the question in this stage, or just in general, how do I utilize the equity in a safe manner without putting myself or my family or my money at risk? There are a couple of things that you can do to actually use equity in a smart way. I think there's a lot of considerations there, but before you access the equity, I would suggest that you ask yourself a few questions. Am I using this debt to build wealth or to fund consumption? That's number one. I think that's a big question, because if you're using it to fund consumption like vacation, that's a massive red flag. If the answer is wealth building strategies, which includes strategic investments, income generating assets, tax advantage strategies, then you're doing so, in my opinion, a more intelligent way. Now, The other strategy to consider here is the emergency fund home equity line of credit. Now, if you have stable income, you're disciplined with your credit, and you want a safety net, it is a smart strategy to consider getting a home equity line of credit. Open a HELOC, get it under refinance. Just don't use it. Let it sit at a 0-month balance. Now, you should always keep your standard emergency fund of 3 to 6 months in a high interest savings account, ideally, so that you can access it at any time. But the HELOC in this case acts as a second layer emergency fund for any catastrophic events, major home repairs, sudden job loss, or medical emergencies. And I've seen this happening. This makes sense because you're not paying any interest on the money you're using, but you have instant capital if you need it. Interest rates on HELOCs are currently around 5.5% to 6% for the most part. In some cases, under 5%. But either way, it's substantially better than a credit card or a payday loan. If you use it, treat it like a loan, make a repayment strategy, and pay it off immediately. Don't use it like a slush fund or use it for discretionary spending. And make sure to review your balance. Some people just pretend it's not even there. The second strategy to consider is debt consolidation. Now, if you have high interest debt on credit cards or other credit lines, let's say you have $20,000 in a credit card debt at 20%, which is $4,000 a year in interest, a $15,000 car loan at 8%, $1,200 per year in interest, and you've got this $35,000 worth of debt, you can consolidate that down into a line of credit at that 5 to 5.5% range and reduce your total interest costs by over $3,000. Now, you should only do this if you're committed to actually paying it off and not running up your credit card again, or creating some kind of a fixed payment schedule. I would suggest considering closing or even limiting your credit card if you have a problem and you're in a position where you keep doing it. My warning is that this strategy can completely backfire over and over again. If you consolidate debt and then run up the credit cards again, you're screwed. And if you don't have an extra line of credit, you're not able to utilize that. Now, in that scenario, you're in a bit of a stronger position when it comes to interest, and you're able to dig yourself out of a hole. The third factor to consider is payment reduction and cash flow, quote unquote, smoothing. So maybe you're mortgage rich, but you're cash poor because your mortgage payment is, let's say, $3,500 a month. If you have a readvanceable mortgage, you can look at the possibility of paying down your principal and opening up your line of credit. Now, you can use this for a few different ways. Again, you need to be very careful, and I'm going to give you a warning. This isn't for everyone, but one thing you can do is you can smooth out your income over time. Let's say you have self-employed income where you make a whole bunch of money at one time of the year and not so much the other time of the year. You can use your HELOC to kind of smooth that up and cover up any shortfalls in the midterm as long as you're paying that off. Or you can make lump sums on mortgage payments and then borrow it back if you need to. My feedback would be that if you get that $10,000 bonus or that extra money, you should consider the possibility of adding that right to that line of credit. And it only works if you're very disciplined, if you track your net position as it relates to both of those factors, and your goal should be to reduce your overall debt over time. The fourth strategy you consider, and this is a bit more risky, and I've talked about this as one of the reasons why Canadians are in trouble, which is the investment property play. If you want to buy a rental property, but you don't have enough cash for down payment, or you want to use it to leverage interest, as long as the cash flow can make sense, then you can use a HELOC to fund the 20% down payment on investment property. I've done so on 4 occasions, and it's made sense for me in all those circumstances because I did the math. I knew the purchase price, the down payment, the interest costs, and I had a buffer in place so that if something went wrong, I was able to put myself in a better position. There are risks associated with that. Obviously, if you can't find tenants, you're covering 2 debts. If the interest rates rise like it did before, your HELOC costs rise as well. If property values drop, you could be over leveraged, and rental income obviously isn't guaranteed. There are some definite rules. Only do this if you could afford to cover the cost of both properties without rental income. You got to have at least 6 months of reserves, in my opinion, and understand tenant agreements, of course, all that kind of stuff like you would for any situation. I would say this is probably not the best circumstance for somebody who would be considering themselves an investment beginner or someone who doesn't have clear understanding of their personal finances. But with everything I've covered so far about HELOCs, there are some advanced tax strategies that a lot of people are talking about right now, but I'm going to put a massive warning on all of these because I don't think that they're right for the vast majority of people. Maybe 2% of Canadians should consider the possibility. And this is the part that I think that most mortgage brokers either don't explain, most accountants don't implement properly. But if you are a high income earner, there is a way that you could save tens of thousands of dollars. One is called the Smith maneuver. Again, I'm not promoting this or recommending it, just explaining what it is. Smith maneuver is basically a Canadian tax strategy that converts your non-deductible mortgage debt into tax-deductible interest debt over time. Now, how the CRA rules work is that your mortgage interest on your principal home is not tax-deductible. The interest on the money borrowed is tax deductible if it's used to invest. Basically, the Smith maneuver uses this legally. What it does essentially is that you have a readvanceable mortgage, which is a mortgage plus a line of credit. You can immediately borrow the money from the line of credit as you pay off the loan, and you can utilize that to invest into income generating activities such as stocks, ETFs, investment properties. Because you borrowed the money to invest, the home equity line of credit interest is now tax deductible. And over 20 to 25 years, you can gradually convert your entire mortgage into a tax deductible strategy. I want to be really clear. Again, this is definitely not for everyone. And in the last couple of years, it's been a hot topic along with this other factor, which is called cash damming, even though those are two separate considerations. But in either case scenario, you have to work with an accountant who can track this. You have to be very diligent in knowing your numbers. Otherwise, you're going to end up putting yourself in a position where it ends up just costing you more money than it could benefit you. Some of the benefits, obviously, you're converting the debt, you're building wealth outside your typical home, and you have significant tax savings over time. Some of the risks is that you're increasing your total debt. There's no guarantee on your return on your money. You have to maintain really, really strong records. If you lose your income, you're servicing multiple debts, and it requires an extreme amount of discipline to be able to put this in place. Now, I'd recommend this for somebody who is high income, earning over 35% tax bracket, someone who has a long-term investment strategy, 20 plus years, comfortable with investment risk in the marketplace, very good financial discipline, and stable employment. Anybody who's uncomfortable with debt, has a short time horizon, which is 10 years or less, unstable income, low risk tolerance, or just like a first-time home buyer or somebody like that should not look at this at all. My take on it is that it could and it can be a mathematical, brilliant, legally sound strategy, but it's complex and risky. And if it's done incorrectly and psychologically you don't get it, then it's just going to end up costing you more time and money. And I've seen people blow up because it didn't work out very well. I mean, blow up as in it stressed them out and they weren't able to actually follow through on this strategy. And so I'd probably avoid this for the vast majority of people unless you're willing to go down that advanced strategy route. Now, there are other factors that you can consider, such as using your home equity line of credit to purchase or renovate rental properties. That interest is typically tax deductible. You can use it for business use. If you're self-employed and use a home equity line of credit funds for business purposes like equipment or inventory, that interest may also be tax deductible. But I would watch out for a few things. The CRA is watching, and they've been auditing Smith maneuvers and investment interests more aggressively in recent years. You have to document everything, every penny, everywhere it goes, and you definitely should be getting professional advice. I do not recommend doing this on your own because you saw this on an Instagram or a YouTube post. So the bottom line here is that here's where we are. After all that, Canadians are borrowing against their homes at the fastest rate in 13 years. And for some people, I think there is some smart leverage happening. And for others, I think this is a sign of the times and the financial stress. The question I would ask you is, which camp are you in right now? As discussed, consider a HELOC if it makes sense from a strategic perspective, if it makes sense for an emergency perspective, or you're using a tax advantage. Don't use it for vacations, for lifestyle, for covering ongoing cash flow, or speculative investments that you know you can't cover from that perspective. The bottom line, in my opinion, is that HELOCs are not inherently good or bad. They're a tool. And this is exposing where we are financially as a country as it relates to people having to borrow more money than ever before. Now, I'm watching what's happening in the next couple of weeks to see what happens where with HELOC growth potentially increasing or growing going into these renewals in 25 and 26. I'm also looking to see if this is more regional in Vancouver or Toronto, and if we're going to see a rise in alternative lending, which is another sign of stress in the marketplace. Of course, one more thing before I let you go, one of my personal rules on home equity is never borrow more than 50% of the available equity that you have, if possible, and always have a clear repayment strategy, which means if you have a home equity line of credit, 200 grand, try to keep that to using only $100,000 available if you possibly can. My name is Alex McFadden. Again, if you found this information helpful, make sure to hit that subscription link, leave me a rating on iTunes, Spotify, or give me a thumbs up on YouTube. And I'd love to hear your feedback. Leave me some comments on if you think financial stress is causing Canadians to have a tougher situation with HELOCs right now, and if you are still planning to use your HELOC to invest in this marketplace.